On this side of the Atlantic, the headline macroeconomic feature of the week will be the Bank of England's first Monetary Policy Committee meeting of the year. Governor Andrew Bailey and the MPC are seen as near certainties to sanction a second consecutive interest rate increase to 0.5% on Thursday, the 3rd of February. The bank previously hiked in December to 0.25% from the record low of 0.1% that had prevailed since the pandemic hit these shores in 2020. Economists and investors will also look for any comment on quantitative easing, where the Bank of England has currently committed £895 billion to its asset purchase facility. The US Federal Reserve is publicly raising the prospect of turning QE into QT, quantitative tightening, and it'll be interesting to see if the Bank of England feels the need or believes the UK economy is robust enough to think in the same way. Note comments from former Bank of England Deputy Governor Charlie Bean in January that the Bank of England may have been a bit late on moving to check inflation with tighter monetary policy. Now, only you can decide whether Mr. Bean or Mr. Bailey are on the right track here. The key issue is whether the current interest rate of 0.25%, with the additional stimulus from QE, is appropriate, given the perspective that it will take any rate hike some 18 to 24 months to have an effect on the real economy. Now, right now, a 0.25% interest rate, frankly, feels a bit low when inflation is running at 5.4% on the Consumer Price Index, unemployment's just 4.2%, house prices gaining at a double-digit rate, the economy is forecast by the Office for Budget Responsibility to grow by more than 6% this year, and the stock market's pretty close to all-time highs. But the question is where these numbers will be in 2 years or so. Even if the Bank of England's argument in favour of studious inactivity in 2021 was that it wanted more data on the jobs market, data that by its very nature is backward-looking. It's also worth remembering that the last time inflation as measured by the CPI stood at current levels was spring 1992, and interest rates were at 10% then. As a counter to that, debt levels were much lower 30 years ago, and higher borrowing levels now may be one factor that's influencing Bank of England thinking as we speak. Now, on the corporate front, the US fourth quarter reporting season's at full tilt, and Europe will start to get in on the act as several corporate and economic bellwethers report their earnings for the final 3 months of 2021. In the coming week here in the UK, trading updates at the end of last year are still the order of the day, while around half a dozen FTSE 100 firms are in the diary for that, and a number of mid and small caps are scheduled to do the same. Now, names which may be further research include the following, although again, do please note that some of these dates could yet be subject to change. Everaz and S3 on Monday the 31st of January, Virgin Money UK and Jules on Tuesday the 1st of February, Vodafone, Severn Trent and Glencore on the 2nd, BT, Compass, Renishaw and Cranswick on the 3rd, and Airtel Africa on Friday the 4th of February. But the company which could really cause the biggest fuss in the week ahead is Shell. The oil major, newly renamed as part of the switch in its tax domicile and headquarters to London from Amsterdam, is set to release its fourth quarter and full year results on Thursday the 3rd of February. The shares are up by over a third in the past year, buoyed by a 60% surge in oil prices and a 75% rise in natural gas. A messy set of third quarter results in October didn't particularly hold the share price back for long either. Those numbers were marred by more than $5 billion of mark-to-market paper losses on derivative positions used to hedge oil and gas prices. And despite surging hydrocarbon costs, stated pre-tax profit actually fell from $4.1 billion in the second quarter to $1.2 billion in the third. Even underlying profit on a current cost of supplies or CCS basis was hampered by output losses in the Gulf of Mexico in the wake of Hurricane Ida. Analysts and shareholders will doubtless be looking for a tidier set of fourth quarter figures when they'll home in on a few select key issues and numbers. Now, the first one is naturally profit. The headline figure to watch here is underlying profit on a current cost of supply or CCS basis. The consensus forecast for 2021 as a whole is $21.7 billion against just $4.8 billion in 2020. For the fourth quarter alone, that implies adjusted CCS earnings of $8.8 billion US dollars, up from just 393 million in the same period in 2020. Analysts will also look to the mix of earnings between upstream integrated gas, oil products, and chemicals. Attention will then switch to cash flow, which topped $6 billion for the third time in 5 quarters between July and September. And cash flow is important because it funds investment in the business, and after that, dividends and share buybacks for investors. Shell returned $2.7 billion to shareholders in the third quarter alone via these mechanisms, and the $0.24 a share or 24 US cents a share dividend payment for the third quarter left the company on track to be the third highest dividend payer in cash terms within the FTSE 100 in 2021, behind only Rio Tinto and BAT. Remember also that Shell's committed to a $7 billion buyback operation in total after the sale of its onshore shale assets in the USA last year. The last number that may grab the headlines is capital investment. Analysts are looking for 2021 to come in at $19.4 billion, up from $16.6 billion in 2020. Any guidance for 2022 from Chief Executive Ben van Beurden will be of interest. Analysts expect an uplift to around $22 billion, but that still leaves the capex to sales ratio no higher than the middle of its historic range. Even if oil and gas prices are firm, demand seems strong, and supply is not growing much, if at all. Moreover, the mix of spending will be important as Shell seeks to reposition itself for a net zero carbon world. Now, as a final point, it'll be interesting to see whether Shell makes any comment on the calls from activist investor Daniel Loeb of Third Point for a breakup of the company and the separation of the fossil fuel and renewables operations. Shell pushed back hard on that when the activist first went public in October, arguing that cash flow from hydrocarbons would fund the investment in and development of renewable and alternative sources of energy. I hope that you and your families are all in good spirits and keeping well. Thank you for watching, and I look forward to seeing you again next week.